Okay, so my name is Gareth Campbell and I'm a senior lecturer in finance at Queen's University Belfast. And today I'm going to talk about the rise and returns of investment trusts. So this is actually the 150th anniversary of the first investment trust, the Foreign and Colonial. So it was set up back in 1868 and its structure at the time was to basically to allocate £100,000 into 16 different types of foreign government stocks. And the aim was to give investors access to very high yielding assets, but to try to actually minimize risk for them. So by trying to spread around risk, it meant that those investors could hopefully obtain a better trade-off in terms of risk and return. Now, at the time, the newspaper, The Times, actually commented how useful this concept could actually be and said that it was something that was very much needed. Now, since that point, that structure has turned out to be very, very successful, and it has led to the growth of an entire sector. So over the past 150 years, there has been a very, very strong growth in the number of trusts. It has actually then inspired lots of other types of investment vehicles. So any type of fund, any type of trust is actually from this basic idea of probably spreading around money into lots of different assets. So what I do in my research is to try and get as much information as possible on all of the different assets which existed over the past 150 years. And from that, I can try and work out, well, how have share prices changed? How have those different assets earned those changes in yield? And how has that actually given investors those returns which they were actually hoping for? So from my research, what I've then been able to do is compare the performance of investment trusts against lots of different types of investments. So I have all of this information also for different types of bonds, preference shares, and various types of shares. And what I can do is try and work out, well, how correlated are investment trust returns with all of these different assets. And what my work actually suggests is that there has been quite substantial change in how the investment trusts have chosen to invest over the past 150 years. So the trusts initially seemed to focus on foreign government bonds. And the aim was to actually give investors exposure to all of these different types of assets being issued by different countries around the world. But as the 19th century progressed, investment trusts increasingly moved into equities. And specifically, they seem to actually move towards the companies which were maybe slightly smaller than average. So by the time we reached the 1970s, there's actually been a very, very considerable and dramatic change in how investment trusts have decided to put their money into assets. And from the 1970s onwards, it seems to be heavily into various types of equity. From actually trying to understand their strategies, there seems to have been this change then in terms of actually trying to track the market, to try and make sure that the assets which are invested within the investment trusts broadly match the assets which exist throughout the entire market. From my research, what I can also do is then work out, well, have the trusts perhaps outperformed the rest of the market? Have they earned some sort of alpha above and beyond what investors could have got from just putting their money into a broad market index? And what I find is that this performance tends to change quite considerably. So it's not the case that alpha was high at the start and then has fallen, or indeed vice versa. There seems to be particular times whenever alpha has been high. So particularly during the 1920s, there have also been periods whenever alpha seems to be particularly low. And it doesn't seem to be any particular trend in booms and indeed busts, but there seems to be this component where alpha has actually gone up and down during different periods. So to try to push that slightly further, what I've done is analysed how various trusts have performed during various crises. And the first crisis I look at is called the Bearings crisis of 1890. Now this is actually quite interesting because there had actually been a boom in investment trusts in the late 1880s, and lots of new investment trusts actually got started during that period. But unfortunately, within about two or 3 years, the economy in South America actually faced very, very substantial difficulties. Now that led on to problems within the financial sector in Britain, and the trusts were actually very, very heavily exposed to this. So what happened was they seemed to perform much, much worse than many other companies that were listed at that time. In contrast, if we look at one of the other well-known episodes, the Wall Street crash of 1929, we actually find something which is quite different. Because during that period, the broader market actually fell very, very substantially, but the investment trusts seemed to perform much, much better. And there could be various reasons for that. It could have been that the managers of those trusts were able to predict what types of assets were going to perform well or not. Or it could have been just exposure to different sectors, and that they maybe weren't as exposed to assets in in North America than some of the other parts of the market was. And then the final crisis that I look at is actually the crisis of 2007. And what we find here is that actually the trusts very much match the market. So whenever the market falls, trusts actually fall by very, very similar amounts. And we can actually see that pattern emerging because it seems that trusts now in this era will actually follow the market much more closely than they did historically. And there are some good points to that. So it means that the trusts actually give a very broad exposure to investors, but the downside is that it actually makes it much more difficult to earn alpha. So the last thing which I actually look at then is what determines which trusts will actually survive long term. And I break them down into different periods, and I find that in the period now, that actually trusts which have a higher alpha will actually be much more likely to survive. Similarly, trusts which will actually track the market will be more likely to actually exist long term. Whereas exposure to smaller companies puts them at a much greater risk of failure. Now, what's interesting is we don't actually see that pattern emerging historically. And there doesn't seem to be any real clear determinants of what has actually determined the survival of trusts from those very early periods. So what this work should hopefully try to show is how the strategies of investment trusts have actually changed over time. So they have moved away from being focused on foreign government bonds towards there has been this shift towards maybe smaller stocks. In terms of alpha, there have been periods where they've done well, periods where they haven't done so well, and actually now is one of those periods where the trusts seem to actually be performing well. In terms of the various crises, Again, there doesn't seem to be a really consistent pattern over time. During some periods, the trusts have performed better than the market. Sometimes they have performed worse. And during the recent crisis, they actually tracked the market quite closely. And it seems to be that those trusts in existence now, which can actually earn alpha and at the same time track the market, do seem to be more likely to survive and hopefully will perform better long term.